Welcome, everybody, to our webinar on the California law and carbon accounting this morning. This is going to go for about half an hour or so, but we have time for Q&A as well. So please note your questions and we'll address them towards the end. And let's go ahead and dive in. All right. So we're very pleased that you're here. My name is Jason Hodell, and I came from industry. I joined Cherry Bekaert about a year ago, coming from Skull Candy, a headphone company where I'd been there for about 10 years. As first the public company CFO, and then later the CEO. Carbon accounting and ESG was a very hot topic for us, and we're very proud to say that last year we were named Walmart CE Supplier of the Year, and sustainability and carbon was absolutely a big part of that equation.
Great, thanks Jason. My name is Joe Hainer, really excited to be here. I'm a partner in our risk and accounting advisory services practice. I lead our carbon reporting solutions, and really excited to be able to talk about this new development here with the California law around carbon reporting and carbon accounting.
Good afternoon, everybody. Thank you for being here. I'm Gabriella Payne, Sustainability Senior Manager at Cherry Bekaert. I joined the firm earlier this year from Fitch Ratings, where I spent over 15 years rating municipal bonds, and where I also got my start in the sustainability space 5 years ago, assigning ESG scores to the water and sewer utility sector portfolio. Assignment of ESG scores was helpful in communicating to the markets how ESG factors were integrated into the credit ratings. The objectives for today's webinar are understanding that what California Senate Bill 253 and 261 means for your company. We're going to get an overview of the carbon emissions accounting and reporting landscape. We're going to go over the GHG protocol and give you some suggestions for planning your integration and accounting data to prepare your company for carbon reporting. Finally, we will talk about how you can turn the evolving reporting requirements into a value-added advantage for your business.
Great. Just give you guys a quick overview of Cherry Bekaert, the firm. So we're a national firm, about 2,500 people, around 600 million in revenue, fast growing, and really covering every state from the north to the south, from the west to the east in the United States, and also have an international capabilities. We're only talking about California today, but we also covering activities in Europe for our clients. So we have a bench there and can also support with European carbon reporting or carbon accounting questions.
And for the industrial and consumer goods group, which I head up, we have about 8,000 customers, mostly in the Southeast US. And as most of you might know, the Southeast has a fairly strong manufacturing footprint. And so as we get into carbon and the tax credits and incentives, that's a hot issue for the middle market industrial sector, which we're focused on. All right, so let's give you the big picture, guys. So the good news is that about half of the carbon footprint of planet Earth, half of the emissions that are created today, those countries have stepped up and either gone ahead and put it in law or a policy statement that they're going to meet the Paris Climate Accords, which means they're going to try to be net 50. Okay, that's great. That's the good news. And included in that, of course, is the US, but also China. All right. China right now has the largest carbon footprint of any country on planet Earth. All right. So it's great that they're part of that. Okay. The bad news is half of the emissions have not been signed up by the countries in terms of the Paris Accords. And if you look at the map here, the countries where we need a little bit of help are the Middle East, Africa, and Mexico's in there too. And those are exporting countries for the most part. So that's the lay of the land. The near-term goal for the Paris Accords was, hey, by 2030, let's everybody cut our emissions by half, all right? And the way they came up with that was, we're trying to limit the increase in global temperatures on average to only 1.5 degrees Celsius or less, of course, okay? And that's called the Science-Based Targeting Initiative, SBTI, down there in the lower right. Let's demystify that for one moment. The scientists took a look at what level of temperature increase we would start seeing kind of unprecedented catastrophic atmospheric effects. And that's the 1.5 degrees Celsius increase, all right? So trivia question would be, so how far along that continuum are we today? Okay, and the answer is the increase since pre-industrial levels, it's about 1.2 degrees Celsius. So the good news is we're not there yet, but we are getting close and the clock is ticking. Thanks, Gab.
Excellent. And they're kind of setting the stage for now going a little bit deeper into the legislation and California specifically into the California climate disclosure laws, which was just enacted a couple of weeks ago. And technically we have two laws here. We have the SB 253 and the SB 261, which are, on the first perspective, first view, they seem to be very similar, but there are quite a bit of differences. So for SB 253, it's very much focused on the GHG, so the greenhouse gas protocol, which is also what is used in primarily in Europe and some other countries who have been implementing these standards a little bit earlier than California. And there will be some synergies if you have also European activities where you can report or you have to report under GHG protocol. In general, you see that the scope for 253, how do you get into the consideration, is that applicable to your company, you start looking at your revenue number. And if your revenue number is 1 billion or larger for your global activities, then you have to start looking into the California climate disclosure law in general. And we recommend doing an assessment and say, okay, we passed their threshold. What are the other factors we need to comply with, or we need to take a look at to make sure that that law applies or not? And then what does it mean in getting my organization to compliance? One last note here for 253 before I hand over to Gabriela, who's going to cover 261, is really the time frame. So while we have a starting requirement for the reporting, for the full reporting on 1/1/26, there needs to be comparable numbers for 1/1/25. So you basically only have the year 24 to really get ready. And towards the end, we're going to talk a little bit about what we see with clients and current challenges. So the 12 months period sounds fairly long, but once you get into the details and depending on the complexity of your supply chain, this can be this time can go by fairly quickly. Gabriela?
Thank you, Joe. So I'll go over Senate Bill 261. Senate Bill 261 has a lower threshold at 500 million in global revenue, and it requires reporting climate-related financial risks and how a company is essentially dealing with such risks. Reporting is required under the framework developed by the Task Force on Climate-Related Financial Disclosures, or TCFD for short. Although Senate Bill 261 does not specifically dictate carbon disclosures, the TCFD does include carbon emissions in its framework. Disclosures under Senate Bill 261 are due biennially, and the bill requires companies to post disclosures on their company website.
So a couple questions we're getting from lots of clients, especially from private equity players on the two bills. Number one, hey, is this going to apply to investment companies? Are we going to have to consolidate all the revenue of companies that we own and therefore report to California? Is that it's kind of unclear at the moment. If you read the laws, there is more guidance that's going to be forthcoming from the state of California on that issue, okay, consolidation or not. It could affect investment companies and private equity players, but more broadly, there's a lot of pressure upon banks, investment banks, commercial banks, private equity players, and venture capitalists to understand the carbon footprint of the investments or the loans that they're making. And that could apply very well in the way California treats this, and it could be mandated, but it is a TBD. Thanks, Gab.
Thanks. The TCFD framework is comprised of 11 disclosures within 4 core pillars. And the disclosure of carbon emissions is included in here in the metrics and targets pillar, as we've highlighted here. Recognizing that emissions are a prime driver of rising global temperatures, measuring emissions has become a key focal point for policy, regulatory, and market responses to limit climate change. As a result, organizations with significant emissions are likely to be impacted more by transition risks than others. Also, current and future constraints on emissions may impact an organization financially. Although most of the other disclosures required under the TCFD are qualitative in nature, these do require a very thorough analysis of climate-related risks and opportunities. The TCFD guidance strongly encourages all organizations to disclose the Scope 3 greenhouse gas emissions because this is a very significant metric to reflect an entity's exposure to climate. So the mandates for emissions reporting are gaining a lot of momentum. Many companies are already disclosing. In fact, the CDP reported that 23,000 companies reported this year. That was an increase of 24,000 from the prior year. There are tangible business benefits to measuring and reporting emissions. Proactive companies are protecting and improving their reputations through transparency and responding to rising environmental concern among the public and their customers. Being able to track and benchmark progress after setting your baselines will allow you to measure and reduce your regulatory risk. Proactive companies that have started their measuring and reporting journeys early are gaining a competitive advantage over others that are non-responsive to supply chain questionnaires. These proactive companies are securing shelf space with retailers, and they're increasing revenue generating opportunities and securing access to lower cost of capital. This brings us to the first poll. What is the revenue threshold for California Senate Bill 253 application? This is going to be open for about 30 seconds. We're almost at 100%. Okay. That was a pretty mixed response, but D has the maximum, and that's the correct answer. The law is agnostic as to where the revenue was generated. If your company generated $1 billion globally and is doing business in California, the company is subject to Senate Bill 253. Move on to the second poll, back to back. One criterion to determine that a company is doing business in California is A, a company has 250 employees in California. B, a company is engaging in transaction for the purpose of financial gain in California. C, a company has a minimum of $690,000 in profits in California. Or D, none of the above. Have a few more seconds to finish this one. Very good. Everybody is keeping up with this. The correct answer is B. Both California laws have a very broad scope. Doing business in California is defined as either engaging in any transaction for the purpose of financial gain in California, or being organized or commercially domiciled in California, or having California sales exceeding certain thresholds. Only one of these needs to apply to be able to be held to the laws. So you could only be offering sales online with no employees or facilities in California and still be within the scope. So why did California mandate emissions reporting ahead of the SEC? The rise in natural disasters over the last decade is undeniable. The bill very specifically addresses the reasons why legislative action was taken. California has had persistent droughts, as well as wildfires growing in intensity, resulting in major losses. Over the 5-year period from 2017 to 2021, it was estimated that an average annual losses from wildfires totaled over 117 billion. That was annually. Of this amount, an estimated 5 billion annually was a fiscal loss by the state of California, and that was attributable to reduced tax revenues and increased wildfire response costs. The persistent drought in 2021 and 2022 was estimated to cost the state's agricultural industry alone over 2 billion in aggregate. The climate-related losses are material. If California was a sovereign nation, its economy would be the 5th largest in the world. So California's GDP in 2021 represented over 14% of the total US economy. This is very material to the country. So climate-related risks need to be addressed soon. The 5th National Climate Assessment was actually released just earlier this month. This shows how climate change is affecting each state in the United States. California is impacted by extreme weather. You can have the overall very low annual precipitation that results in long sustained droughts. We've seen it in the last 10 years. We've seen two very long sustained droughts. But also you have very infrequent short downpours that result in heavy infrastructure damage due to the intensity. Another climate risk that scientists have been observing for years is the country's temperature warming, and this is affecting our entire country, and sea level rise along the nation's coastal states. Notably, after the fire seasons of 2017 and 2018 wiped out decades of insurance companies' profits, some companies began dropping tens of thousands of customers by refusing to renew their policies. By acting now, California is protecting its environment, which is a major factor that has boosted the state's economic prosperity.
So the big retailers, the tier 1 largest retailers in the world, they get credit for stepping on the gas pedal and getting a lot of this reporting started. In fact, at Skull Candy Headphones, we got the report from Walmart that we had to fill out and give them the carbon footprint of every product that we wanted to put on a peg in Walmart. And this was several years ago. So Walmart's out ahead of it. Amazon and Target have followed suit, okay? And so for our clients, a lot of times they're getting a questionnaire from a retail partner or a supply chain partner, and that's starting the wheels in motion for them to get organized and start to assess their carbon footprint. Thanks, Gab.
So the big question now is where to start and how to approach it. So while there are more steps involved than what we have on the slide, we just try to break it down in 4 ways to think about it. So one, we think you have to think about to measure your emissions. So think about the GHG protocol. I haven't seen the list of attendees, but if there are folks from the CFO, controller, chief accounting officer side, think about this like equivalent to GAAP, right? So there's like a standard, and there are like rules, and then you basically assess your organization, you measure the emissions, and then you can define gaps or differences, and based on that, you can start developing a strategy for reducing your carbon footprint. And what you want to do and what you gonna find out after the strategy assessment and developing a roadmap, that most of that information is or the reporting is, most of the reporting is data driven. So you need to find and develop a data strategy. Where's the information coming from? What systems are you going to use to prepare reporting? How much can be automated? How much resources, knowledge do you have in-house? What do you need to bring in from the outside to support with the process? So that's step one, measure your emissions. Step two is really looking step deeper, analyze your emissions. Where are your emissions coming from? And we're not really talking about scope 1, scope 2, scope 3 here. It's really like a broader perspective at this point. And then what we think and what we found out over the first couple of projects we did here is really that Cherry Bekaert as a core, and you saw it maybe in the beginning, is a CPA and advisory firm. So we really understand how to develop an audit trail. We really understand how to develop a strategy around a GHG protocol, which is fairly close to GAP. So it's really and close to our core competence to basically attack these topics. Jason?
Sure thing. And then as you're analyzing, this is where the project becomes a bit more fun, because once you have an assessment of your carbon footprint, it's going to be broken down by process and by raw materials and supply chain components. So for example, in a headphone company, we discovered the lithium-ion battery was the worst part of the headphone from a carbon emission standpoint. So, in the next generation of the headphones, we reduced the size of the lithium-ion battery by about half, and nobody was bothered. The retailers weren't bothered, our consumers weren't bothered. So it was a win for everybody, especially planet Earth. We also want to underscore that, on our team, we have professional engineers that are also CPAs that sit within our tax credit and incentives group. And what they want to look at is, as companies, our clients are coming up with projects to reduce their carbon footprints, think renewable energy and those sorts of things. Number one, we want to help you understand how much it's going to cost. But number two, we want to get as much of that paid for by government, federal and state incentives, grants and tax credits. And there's accelerated depreciation as well. So all sorts of benefits financially to help fund everything that's going on here. And the dollar amount that's available, this sounds too good to be true, but it's about $2 trillion. It's over $2 trillion of federal and state tax credits and incentives on this very topic.
Excellent. So once you have analyzed your emissions, you want to look at goals and goal setting. And what we see with clients and discussions we have is really about using science-based targets. So if you want to be measurable, if you want to have like even documentation reporting, which can be audited by a third party, then you want to stick with science-based targets, and you also want to be realistic with setting your goals. And you might have heard the term greenwashing and some of the other initiatives. So more and more organizations are cracking down. I can see this already in Europe happening, that oversight boards, just read something about the Financial Oversight Board in the UK starting looking into specifically public companies and what they're saying in their notes and their financial statements about their carbon footprint and their strategy, how to reduce it, and challenging certain statements in there. So you want to be realistic and really think about this holistically and what can be done. And Jason, do you want to add something
Sure.
about these great partners?
Yeah, so if you want to have a peek into the future and where this is all headed, just look at the packaging of Oatly milk that's in your grocery. It's oat-based milk. They're publishing how many kilograms of carbon dioxide equivalents for each, container of milk right there on the package. So just like price, people of course shop on price. Now, if you're generally in the same neighborhood on price, the consumers are going to start looking at how much carbon is being emitted by this peg. Okay, so naturally we're going to start driving change. So when you get to forecasting where this is all headed, it gets complex. All right. One thing we want to highlight, we're an official solutions partner with Salesforce, and they're one of the leading carbon accounting firms for calculation, and they call it Salesforce Net Zero. All right. It's one of the best. They've embedded AI, it's called Einstein AI, into their net zero package. So once you do your footprinting, it'll ask you for a set of assumptions for how the business is going to change its rules in the future. And like my example with the lithium ion battery. And then Einstein AI will help you and your engineers forecast where your carbon footprint's going to go. And that's whenever we can all start feeling better. Are we really going to get there by 2030 or 2050 and really hit these targets or not?
Jason, I believe there was a question from the audience with the lithium ion battery example you gave. Was there cost savings associated with this change? Excellent question.
So yes, absolutely. By changing the battery by half, everybody saved money. We were able to reduce the price of future generations of headphones. The user experience was fine. Nobody complained. And planet Earth was better. So triple win.
Thank you.
Great. Yeah. So lastly, point 4, really looking at how you report your emissions and the goals for the stakeholders. It's kind of looking at this holistically in a sense of thinking, okay, why do I need that carbon reporting? Is it compliance? Is it because I want to be a first mover? Am I going to use that to be more attractive in the capital markets? And we heard about some funds and some organizations who really start focusing on green investing or channeling funds into green investment opportunities. And that will drive some of the reporting and how you want to approach it. And then lastly, with there are some initially soft audit requirements for the carbon reporting here in California, that you have it built out so that a third party can measure it and test it, and there's an audit trail. Gabriela?
I'll go into the to the measuring basics now. The GHG protocol is a gold standard. The standards have 3 frameworks: product, project, and entity. And entity is also known as a corporate standard. The California legislation calls for the corporate standard, which is the simplest, and actually it's the most industry agnostic. There were the only exemption from the California laws, if you recall from the prior slide, was insurance. So the entity corporate standard would be the most industry agnostic standard to use for measuring your emissions. I'll just explain a little bit now about defining your corporate boundaries. So the first task is going to be you need to determine your corporate boundary. Under the greenhouse gas protocol, there's 2 approaches for determining what constitutes the reporting company going forward. The approaches include the equity share approach and the control approach. The control approach is broken down into 2 further categories. There's financial control and operational control. The equity share approach compels the reporting company to account for all the emissions from operations in which they have an ownership stake. For example, if a company has 15% equity in their office building, they will only measure and report 15% of the emissions for that building. The control approach is the most commonly adopted approach. Under this approach, the reporting company accounts for all greenhouse gas emissions from operations, and the reporting company has either operational authority, or financial authority. Time for the next polling question. I should only worry about scopes 1 and 2 because nobody can measure scope 3 emissions, true or false? Okay, I think we can end this poll. We have 90% participation. We'll give other people a little bit more time. Okay. This is false. Although scope 3 emissions can be tedious and require supply chain collaboration, the GHG protocol actually provides very ample guidance to support measurement. And also, it provides very large opportunities for companies to actually have an impact on the environment. This is why the big box retailers have been requesting supply chain participation in measuring emissions for years now. And we have, as I mentioned earlier, we have been seeing a lot more participation in the CDP reporters over the last year. As I mentioned, there was about a 24% increase in participation in 2023. What's this? So after you've identified your corporate boundaries, it's time to begin your emissions inventory. The GHG protocol organizes emissions into 3 scopes. Scope 1 is for direct emissions, and this includes emissions from sources owned or controlled by the reporting organization. Examples include fuel used for vehicles or energy consumption for on-site equipment like propane gas used for heating, refrigerants for cooling, and fuels for manufacturing equipment and vehicles. Keeping track of fuels, refrigerants, and gas purchases in your accounting system is imperative to simplify your reporting process. A good place to start is to ensure that you are capturing this data in your ERPs and your accounting systems. Scope 1 emissions complexity really depends on your company size, the number of locations you have, where the locations are, and then the number of assets, the complexity of the assets that you have that require energy, and the quality of the accounting data that's available to measure the units of stationary and mobile combustion and fugitive emissions. Scope 2 accounts for indirect emissions from the use of energy, which typically comes from electricity purchased from the grid, from your local utility provider. For many companies, like service companies that don't have cost of goods sold, purchased electricity represents one of the largest sources of emissions and therefore can provide the most significant opportunity to reduce these emissions. Some simple ways to reduce these emissions are to invest in LED lighting or use energy efficient electronics. Very easy to perform energy audits to identify what low-hanging fruits a company may have with the most savings potential. And you can also choose a higher proportion of renewable energy from your power provider, like wind or solar, to reduce your scope 2 emissions. And also, Jason alluded to this, but if you make capital investments in green energy, for example, installing solar arrays, you can even benefit from the tax incentives that are provided by the Inflation Reduction Act. So I tend to think of scope 2 as the simplest in terms of accounting. The complexity for gathering the data is primarily ensuring that all utility provider data is available for all facilities to be included within the reporting corporate boundaries. So depending on how complicated your corporate boundary is, that's about as complicated as your scope 2 emissions can get. During the initial setup, this can be configured to upload the data as the utility bills are generated from the providers. So you can have real-time feedback on this. And the carbon accounting platforms that we utilize are integrated with the utility data that gets directly uploaded, client-specific information based on account numbers and addresses for purchased electricity. So I think scope 2 is a rather scopes 1 and 2 can be, depending on your organization, can be rather easy to calculate, to upload. And of course, scope 3 gets a little bit more complicated. So scope 3 category emissions measurement, it covers all of the remaining activities beyond the range of the first 2 scopes. This includes emissions from both upstream, which is from the production and transportation of products and services you purchase, and the downstream, the emissions from your customers when they use and dispose of your product. Examples are employee travel, waste generation, and purchase goods and services. There's a total of 15 categories included in scope 3. In the corporate accounting standards, scope 3 emissions calculations are optional. However, emerging climate disclosure frameworks like the California requirements are now mandating integrating the requirements for companies to report on scope 3 emissions, including the California Senate Bill 253. So because it's estimated that scope 3 emissions can account for more than 70% of a company's carbon footprint, especially manufacturing companies. And so this can have a very profound effect on informing how a company can act on their carbon footprint. Time for the next poll. Poll number 4, my company generates less than 1 billion in global revenues. So this has no impact on my organization. True or false? Let's give 30 seconds. We have a majority. Give a little bit more time. More seconds, and I'll run the poll here. And this is false. Senate Bill 253 threshold is at 500 million. So this would at a minimum require you to report every other year beginning in 2026 on 2025 emissions. And also keep in mind that your company could be along the value chain of a company that is required to report. So you may be asked to report upstream to your buyers. You may get these in the form of questionnaires from your buyers, or you could also be getting them indirectly from the CDP to report on your own emissions.
All right, guys. So thank you, Gabriella. What you should be taking away from this is that the definitions for inclusion in the California law are very broad, okay? Pretty much any economic activity is the threshold, okay, which is very broad. Secondly, it's 500 million in global revenues, okay, to capture the first net of companies that need to report. But what you just learned from Gabriella is scope 3 and the supply chains, both upstream and downstream, are going to capture so many more firms that are touching the reporting organizations. So there should be, by definition, a great many carbon calculators going out to partners and retailers and suppliers over the next couple of years to get ready for that hit date of 1/1/26 that Gabriella just talked about. Okay, so with that in mind, the choice of your carbon calculator and your digital dashboard, it's absolutely critical. There are very many vendors out there with their own carbon calculators, all right? Some are just scope 1, scope 2. Some also include scope 3. Scope 3 gets extremely complex, so those are more expensive. There is no one size fits all. There really isn't. And the range of these carbon calculators absolutely run the gamut from suitable for kind of startup companies that are suppliers into, say, an auto manufacturer in South Carolina, to gigantic global companies with large ERP systems like a Salesforce, in which case Salesforce Net Zero becomes an easy answer to what's going to be the quickest, easiest, and cheapest way for me to get up and running. So we have a full digital team here. Okay, we are official solutions partners with Salesforce and Microsoft. Net Zero, Salesforce, and Microsoft Sustainability Manager are considered to be two of the leading packages to help large organizations measure this and forecast it. So we're ready to help out. And you really want to have your carbon accounting team, your internal team, working with externally a CPA firm that does carbon accounting like we do, that also has a digital team that can get your dashboards up and running. You really don't want to have multiple organizations involved because that gets difficult to manage. Thanks, Gabriella.
Yeah, absolutely. To add to that statement from Jason, how do we approach it? How do we think about it as Cherry Bekaert? At a core, we are accounting firm with the digital capabilities, so we can be the one-stop shop for our clients, from developing the compliance strategy in the beginning, doing the initial assessments, to really helping with implementation and compliance, and also developing an audit trail for a third party who might come in and in the end challenge or audit the carbon reporting. In addition to that, working with Cherry Bekaert, being a PCAOB CPA firm, so we work with public clients, so we also understand, think about the SEC coming out with a standard probably next year, early next year, will ask for requirements, and that reporting again is going to be trickled down through the value chain and the supply chain to other players and suppliers of public companies. So in general, Cherry Bekaert and the firms is well equipped to help with this, and we're really motivated and committed to make this a valuable exercise for our clients.
And bringing an operator's perspective to that as well. I wish when I was at Skullcandy that I'd known about these kind of services, from professional services firms. We ended up hiring 1.5 full-time equivalents for the mission, at Skullcandy, and those costs add up. Okay. In retrospect, it would have been easier just to outsource this to, an accounting firm that can bring all the different pieces to bear.
Right. Let's talk about the timeline quickly. I started touching on this earlier in the presentation, but just really want to drive that home here with the timeline or the chart. So you really want to think about going backwards here and say, okay, 2026, I have to be able to report, and I have to have. So while Gabriella is putting that up, basically 2026 is your end goal. With 2025, you want to have your reporting. You need 2025 to be able to have comparison to 2024 2026, and then you move into 2024, which is basically starting in 6 weeks, which gives you the timeline to build up the reporting. And the time frame right now, what our clients asking us right now is, hey, can you guys do an initial impact assessment? I can take to my board, I can take to my stakeholders and say, okay, this is how we are prepared for this change or this requirement. This is how we develop our strategy. Here's an initial impact assessment. Is this applicable to us? Yes or no? And it's also true for EU requirements, European requirements, the same ask. And then you really have this year to get ready. And once the strategy is set and you know what you want to do, and you have a an initial path how to want to get there. It's really getting into what Jason is driving home, is that data, and thanks the data requirements, where's the data house, and then as we learned from Gabriella, really scope 1, scope 2, you might be able to have some of that information already in your organization. But once you get to scope 3, it's really how do you get the information, how you derive it from your suppliers. You might even go ahead or might even need to develop a questionnaire or some sort of tool how you can extract it from them. And then, you know, keep in mind that this is an ongoing reporting requirement. So this is not going to be you do it once and then it's done. There will be a more of a lift in the first year, but then it has to be on a more recurrent basis. And then if you're a public company, you might even have to do this a refresh on a quarterly basis with your quarterly filings.
Joe, if I could add,
Sure.
everybody, the questionnaires are coming out from the large global firms already. Okay, so we're helping clients with their answers into, say, auto manufacturers, because there's a large auto supply chain in the southeast of the US. Okay, but then part 2 is they may not have arrived yet, but expect in 2024 for the supply chain questionnaires to roll out, and folks are going to want to have answers probably before the end of the year, so that by the time they get to 2025, they know the answer and they can be starting to make improvements, not just waiting, you know, till the very end of the reporting period and then reporting whatever the answer is. That's not the right way to think about this, and most of our clients are getting ahead of this.
Thanks.
Okay, so I hope what you're seeing here, guys, is we're trying to bring every major piece of the puzzle as a solution to our clients, and thinking of it all the way, you know, to new facilities and new projects. So let's go from left to right. So Joe just covered very well why you should hire a CPA firm to do carbon accounting. Okay, it makes all the sense in the world. So we have that up and running, and it stands right alongside our audit and reporting practice. That we do financial accounting, of course. So that makes sense. The middle, digital transformation, we've already talked about that, but you absolutely want to have that under one house. You don't want to split the responsibility for digital dashboards and your carbon accounting. All right. The fourth piece, tax credits and incentives, that's the $2 trillion of, you know, free incentives, loans, credits that are all available. But here's the key, okay? You can't wait until it's time to fill out your tax return and then hope your tax credit's going to be approved, okay? A lot of the tax credits, you might start with a base tier of a 30% credit, and then you have to check 4 or 5 other tiers to get up to 70 or 80% of your credit back, okay? Those are real numbers. And there's all sorts of items that need to be thought through, and it goes to where you're going to locate your new project, the kind of people you're going to hire, the kind of facilities that were there before, okay? But you want to maximize these credit backs, of course. We have published a public case study on our website where a South Carolina manufacturer powered up a solar field, which is very popular right now, powering 20 megawatts of power in the moment, and they got about 80% cash back on that capital expense within 2.5 years. And that was a combination of federal, of course, state, South Carolina, and accelerated depreciation, okay? All of the above. It's on our website. Just email us if you'd like to get that case study. It's something we like to walk people through. And then the last piece is, you know, there's so much onshoring and nearshoring going on right now. Ever since 2019 with the Trump tariffs, China has been reduced greatly in terms of exports to the US. Little known fact, Mexico is now exporting more to the US than China. That hasn't been that way in a generation. All right, that's happened because of onshoring and nearshoring. So as clients and you all are thinking about where to set up a new location, and then as you're setting it up, how do I optimize my best deal with the county, the state, the city, okay? and get it paid for with these credits, that is a service that we provide. You know, we can work on your behalf with all of those entities and jurisdictions to optimize this for you. And we call that site selection services. So this is all under one roof, and it's a combined service approach that we're very proud of. Thanks, Gabriella. This brings us to poll number 5, everybody. Do you know if your company has hired somebody already to do your carbon accounting? Simple, yes or no, or I don't know. This will be interesting to see because it'll give us a sense for how many folks out there are getting ready or this is on their to-do list. Gabrielle, I can't see how many folks have answered.
Oh, there 100% have answered, and
Oh, perfect.
10% yes, and 66% no's. 24 don't know.
Okay, that's good feedback. And you know what? If you haven't hired someone to help you with carbon accounting, you're not alone. A lot of people are in that boat right now. The California law was just signed in October, so this is all brand new. Okay. And then the last poll question here. Remember, in California, you have to submit your carbon footprint and you have to have an assurance provider, sort of an audit of your carbon footprint. All right. So the question is, have you already hired someone for that assurance piece, that audit piece of your carbon accounting? Yes, no, or we're not subject. How are we looking, Gabriella?
We're at 81%.
Okay.
And growing.
Well, there you go. So you're not alone. Again, a lot of folks are trying to figure this out. And that's exactly why we're here today with this webinar, to get everybody up to speed and help you understand the drawbacks. All right. I think we do have some questions that have been submitted. You want to read them?
Yes, is the revenue threshold on a per entity basis or consolidated basis if part of a consolidated group?
Yep, that was I covered that on the private equity piece. It's TBD, okay? But if you're a betting man, you know, if you look at the pressure upon the investment banks and the financial services community to really understand who they're loaning money to and who they're investing in, there's probably a fairly good chance that they're going to look at it on a consolidated basis and make sure that the investment companies are understanding their carbon footprints.
Here's another good one on supply chain. Do you expect companies with annual global revenues over 1 billion to require their vendors, Scope 3, to also comply with Senate Bill 253?
I think they're absolutely going to ask them to complete carbon footprints. So I think that's a clear yes.
Yeah, I would agree.
Will this apply to a professional employer organization, or will it apply separately to the clients of the PEO? I think this will apply to the PEO organization. And as I mentioned earlier, when I talked about Scope 2, I think most of your emissions would probably be Scope 2 emissions would be purchased from purchased electricity, and your clients can also calculate their emissions. As far as Scope 3, you would have some Scope 3 emissions, and you can send questionnaires to your clients. That would be where you would include your clients' emissions. I think we have a few more questions. Question, if a company has significant remote workforce working from home, do we measure the impact of home office workers?
Technically, the answer is yes. Okay, and many of the carbon calculating modules go ahead and ask questions like that, along with the travel that's required and certain things like that. So yes, although that is one of the more complicated measures that's included in some of the calculators. But generally speaking, the answer is yes.
Yes, and that would be, you could include some estimations on that
Yep,
from
exactly.
information provided by your employees. And, depending on location and you get certain factors from them. It is possible to get this information. If a company leases its facilities, who is responsible for reporting? The lessor or the lessee? The GHG protocol actually has some specific information on this, but basically, when you're determining your corporate boundaries and you're determining who has control over it, it's gonna be control. If you're leasing, say you're leasing a car, the leasing company has no control over how many miles, how much gas you put into it. You're going to be the one that's going to be reporting it. Is company travel part of scope 1 sources, air travel? No, that would be scope 3.
Unless you own the plane.
Unless you own the plane. Yes,
Right.
Thank you.
Joe
Unless
Hainer
you're
has
the
a plane.
1%. Are there any other states in the process of issuing similar legislation to California? I
Very good
believe
question.
Oregon has already adopted some legislation, and I think that there are other states that are going to follow.
So the interesting part here is that there has been a pattern of California basically coming out with a new regulation, and then you can see other states adopting it. There was some a regulation coming out around data privacy, and then it kind of moved through the US, and every state started applying it in some fashion. So that could be also a challenge in the future, is if you have different standards in different states, right? So California is now has 2 specific laws with, details need to be defined over time. Certainly there will be some tweaks here and there, but then technically other states could say, okay, we want to focus on something else. And then it can become really complicated for companies and organizations if all of a sudden they have to report different things in different states. And even more important, that you have a good team, being external or internal or both, to help you through this, and being able to work with an organization on the data and data analytics side, which can adjust their software solution so that you always you don't have to worry about, okay, is that tool I'm using now able to do what the state of Oregon wants?
Okay, I think we have time for another question. Somebody asked, are you able to answer which specific emissions platform you use that integrates utility data? And when you say integrates, do you mean without any manual data entry? Is there a PDF upload process? There is not a PDF upload process. There's an Excel upload process that you can do. The integration is through, I think the company that owns the data or that picks up the data is called Arcadis, and they have a platform with global utility information. So they pick up the data from your utility provider, and then we can pick up the data from that source.
So I think we reached the end of our allotted time, and we have some more questions we couldn't answer here, but we will look at these, and then I think we have the contact information so we can follow up with the rest of the group and answer these. And Gabriella, if you want to click one more, please. Just want to let everybody know that we have put out some further reading and guidance if you are interested in doing a little bit of a deeper dive also around European, and our FAQs might be helpful for you to at least get your initial bearing. And then obviously we really enjoyed being able to have this webinar today and would love to interact with you guys. So feel free to reach out to us. Our contact information is available as well. And yeah, would love to help you guys through that process and be a resource. Thank you so much.
Thanks, everybody.
Thank you.